Well, hey everyone, me Kevin here, coming to you from some kind of rest stop slash McDonald's outside of Oslo in Norway, dressed in Minecraft, basically top to bottom, going to a Viking festival, and here to tell you about why the NASDAQ seems to be rotating and what's going on with the NASDAQ versus equal weight, because that all totally makes sense. So, yeah. With that said, let's get into it. All right, so here's what's going on. First thing, one of the things that we're seeing today is this rotation from technology stocks into consumer stocks, which you might think that's been going on for a while. That would be true if you've looked at Target stock, which we'll talk about in just a moment. But if you look at the last 3 months on an ETF called XLY, or Consumer Discretionary ETF, still down 7% over the last 3 months, which is not as bad as the sell-off that we have seen in memory over the last, 3 weeks since the suckening began. But let's talk about that for a moment. Target was very interesting, and I think it's one you should have on your radar. When it was $86, we probably spent about 2 weeks doing multiple course member live streams on it during the time it was bouncing around in the 80s. What we found was that Target was offering a 5% dividend. They're a dividend aristocrat. They're extremely unlikely, we assumed, to cut that because it would lead to a significant stock sell-off when a dividend aristocrat decides to cut their dividend. That's usually kind of the death of the stock. So really unlikely to happen. And so Target was actually, in my opinion, a really good kind of medium-term play, and it's almost doubled since then. And today we're seeing Walmart, Target, Home Depot. Home Depot has been absolutely battered because of high interest rates. We're seeing a lot of these consumer names pick up. I don't necessarily think that goes on forever. I don't think they're a 10-year play, mostly because of this irony that the more artificial intelligence does really well, not the stocks, but AI, the more of this sort of what we'll call, and I'll describe this in a moment, Engel's pause we're likely to see in the labor market. That's a really important concept that I think you ought to stay to the end of the video to understand. It's actually what gave rise to Karl Marx and, well, Marxism back in 1848, which was literally right at the end of the Engel's pause. We'll talk about that in just a moment, though. But first, we're obviously seeing this rotation out of artificial intelligence stocks today. Hardware stocks are getting beaten up, but a lot of stocks, I mean, even the finance stocks, which were doing well for a little bit of time there until Robinhood dropped below 100 again, nothing has really found stability since SpaceX. And this has been a theme. If you go back, run them through AI, run my last 6 weeks worth of videos through AI in case you missed it, but I think you'll agree with my summary here. It's been pretty clear. We said that SpaceX has a risk of being a top for the market, mostly because it's a liquidity suck, right? This massive 75 turn to $85 billion suck. Then Google comes in with 70 turns, $75 billion of suck. Actually, I think it might even be a little bit more than that. And what's actually remarkable is that Bloomberg is reporting right now that every hyperscaler bond raise is actually upside down right now. Now, that doesn't mean they didn't raise their money. It just means that the hyperscalers who sold these bonds are seeing on secondary markets, those corporate bonds trade at a negative value, so a discount. In other words, more people are wanting to sell those hyperscaler bonds right now than are willing to buy those hyperscaler bonds, which is interesting because some of them were paying pretty good yields. Most hyperscalers seem to pay somewhere around 80 basis points above the equivalent treasury yield. So that'd be like a 5.3% on something like maybe a Google bond. But then you look at SpaceX, they were paying like double that. They were paying close to 150 basis points of premium over the equivalent treasury. So on a 10-year, that's like 6% to hold a SpaceX bond. And I mean, no surprise. I mean, now, the stock has tanked off of its highs quite substantially. And now Apple is the most valuable company in the world, as even NVIDIA has been struggling, which is so weird because NVIDIA GPUs truly in price have basically doubled, a lot of them in value over the last year, just because there is truly a shortage of them. But this move into the consumer today, I think, is honestly just like a little bit of a pain trade where people are like, oh, okay, yeah, we're a little too aggressive here on AI. What are we going to go into? Well, what's the most non-AI? Oh, let's go into consumer discretionaries. Yeah, well, there's some macro problems there as well. I mean, you could look at Nike and call their warnings idiosyncratic, but they're not really happy about the consumer right now. And then on top of the Nike warnings, you should look at what's happening in the credit card markets and delinquencies and chargebacks. Chargebacks are up 29% since 2021, which is way higher than the growth of credit card transactions. And that typically happens when people start getting a little bit more desperate, when real wages fall relative to, the richest getting richer. So people kind of see chargebacks as a way to stick it to the man, if you will. Anyway, then when we actually look at credit card delinquencies, we see 13% of credit card balances are currently 90 days delinquent as of the first quarter of 2026. That is the highest rate in 15 years per the Federal Reserve Bank of New York. And consensus estimates for UBS's charge-offs have nearly doubled by the end of 2026, which is an indication that, there are actually expectations that this consumer is likely to struggle more, not less. making consumer plays really a cool, like, medium term, like, hide from AI. But, dude, if AI tanks, like, this is more than just, like, a shorter term dip. If AI goes to crap, the consumer's going to go to mega crap. It's going to be even worse. But anyway, one thing to watch right now is that RSP, which is an ETF that tracks the S&P 500 equal weight.